Hi folks, welcome. Great to see you all on tonight. And we're just in pre-show mode for a little while, just to let people get up to speed. Damien is queued, ready to rock and roll in a few moments. He's shown me a few of his slides and some very interesting stuff there tonight as well. And I appreciate all the questions before the show. I've got quite a long list, plus all the questions on the show. I will just share a few comments. There's some quite funny ones. I thought this was quite a funny one from a blurred squid. My wife says, I'm obsessed with DFA because I brought my iPad into the showers just to watch the live stream events countdown clock. Very good. Well, whatever, you know. It's very good. And and Cross Stitch Yang says, we're all here tonight for 11-year-old, 13-year-old. Hi guys, good to see you all. Welcome to the live. And yep, we're all good, raring to go. I guess if you're down in Melbourne, there isn't a lot else to do. So come and join the party here. And 11-year-old already investing her Christmas and birthday money. Hey, starting them young. Very good. There's quite a few on already, and we'll just run this for another 30 seconds ago. I'm enjoying the conversation with Cookie Boy about his identity, and somebody claimed that he might have been Tarek by another name, so that's quite funny. That's led to quite a lot of interesting cross currents in terms of discussion over recent times. So, yeah, I'm not sure where that's going to go, but there you go. And great to see some others on as well. It's good to see some of the regulars on again, and it's nice to sort of see you pop up. And you know, this is a bit of a friendly community, hopefully, so I hope you feel very much at home on the show. Right, well, I think that's enough pre-show waffle. I'm going to get rid of that. I'm going to run the intro, and then we'll get started properly. Here we go. Well, good evening and welcome to this live stream event on the 16th of February 2021. Martin North from Digital Finance Analysts here. Great to have you on board. Got quite a few on already and a few more I think will join. And it really is great that you've carved out some time on your Tuesday evening to spend it with us. I had Damien queued and ready to rock. Very interesting conversation coming up. Just before I do that, let me just go through my normal warnings and introductions, just to say this isn't financial advice, it's general conversation, but we don't know your individual circumstances, so please don't take it as such. Do play nice in the chat room, it is being moderated, no racial slurs please. This is at the 16th of February 21, so if you're watching this in replay, you'll know whether we got it right or whether we got it wrong. Use that walk the world please to get my attention. There's always plenty going on in the chat, but if you've got a question for me, use that walk the world. I've also enabled Super Chat, which means that you can make sure your question gets to the top of the list. And also, if you want to make a contribution to our show, that would be greatly appreciated too. And just before I bring Damien in, a quick recognition of Jason. Hi Jason, thank you so much, and thank you very much for the Super Chat. It's greatly appreciated. It really does help to cover some of the costs of what we do here on the show. Plenty going on, of course. Now, let's, without further ado, bring Damien in. Damien, are there?
Hi, Martin. Thanks for having me on again.
Yeah, great. Well, great to have you on. And I think we're sort of roughly settling in on a sort of a monthly cycle, give or take, given everything that's going on.
That's right.
And you know, if you think about our last conversation, quite a lot has changed since then. The markets have gone up higher, you know, the new highs have been capped out. I guess the vaccine rollout is beginning to sort of, you know, take off in some places, including, of course, in Australia shortly, we expect. But also some level of uncertainties too. So I'll be interested to get your latest read on the markets. And what I might do is to hand the control across to you. You can, if you'd be so kind, introduce yourself and then just do your brief intro, and then we'll run through the questions after that.
Yeah, sure. Yeah, look, hi. For anyone who haven't spoken before, my name is Damien Klassen. I run the portfolios at Nucleus Wealth. So we run tactical asset allocation portfolios for lower risk clients. So basically allocating between cash, bonds, Aussie equities, and international equities. And as part of that, we partnered with Walk the World to provide some for Martin as well. But the main thing I want to talk about is the asset allocation side and what we're seeing in terms of stocks reporting and this whole sort of push from central banks and governments to just to stimulate the economy, and we've called it sort of a bit of a fake economy at the moment, in terms of it's all backed up by, it's all sort of reliant on central bank and government stimulus, and so trying to work out where the where does it all finish, and when do we actually start to see a return to capitalism and companies allowed to go broke and more normal valuations is sort of part of the key, which we'll run through tonight.
Normal valuations. What an interesting concept. You mean that valuations of stocks actually have some relationship to the underlying?
Yeah, well, and I've joked as well that, and it's not even a joke. It's basically the saying that the problem at the moment is because last year's earnings are all messed up because of COVID, and even this year's earnings are quite likely messed up because of COVID. It makes it very difficult to do fundamental analysis, so a lot of people just don't bother. So it's sort of too hard. So just go with the momentum and things like that.
Right, and I think that issue of momentum is something we're going to have to come back to, right? Because I last quarter last year we really got this the super fund and the Walk the World funds up and running, because my sense then was that being in the market and getting market exposure when there was clearly going to be a run up made a lot of sense, right? And there wasn't necessarily a lot of underlying logic in terms of the stocks weren't necessarily that cheap, but nevertheless the momentum was clearly in one direction. And I think that's something which people need to understand about when they actually make decisions about where to invest and how to invest.
Yeah, and so it's a question about saying, look, you can be in dangerous, you can be in quite dangerous markets that are quite overvalued, and then you can still try and buy stocks and put either bonds or other things with it to provide you with some protection. But I think there's also this idea that when bad things happen, if you get enough government stimulus and enough bailouts and enough support that can last you until things get better again, then even though markets might be high and overvalued, they might be able to stay high until things finally come good. And at that point, if you've sat there and done nothing but sat on cash the whole time, then you've missed that return. And you might have actually, 2 or 3 years later, you might have actually said, yes, okay, at these prices I'll actually buy in because now I can see the fundamentals. But that's the danger we're sitting in at the moment, is trying to say, well, it's policy error, basically. It's saying, can the governments keep things propped up for long enough for the fundamentals to come through, or will there be policy error in the meantime? And our initial thoughts were there would be policy error, but later in last year we switched and said, well, look, you know what, it isn't looking like it, and it is looking like they're just going to keep throwing more and more money at it. And so until we start seeing more signs of that policy error, then central banks are keeping rates low, trying to get you out of cash and into the market. And unfortunately, there's not a lot of other games out there.
And of course, the point there is as well that the Reserve Bank minutes today reconfirmed what they'd said previously, was they're going to do more quantitative easing for longer, right? So effectively, absolutely, that's another plank in this momentum play and this momentum story we're talking about, right? There is no sign at all that they're going to turn it off. They're going to keep rates low for a very long period of time. I think personally close to 5 years is probably minimum now. They're going to continue to pump more liquidity through into the market, give more cheap funds to the banks to allow them to lend cheaply, and basically turn that QE handle to try and get the real economy back to life. The question, of course, is, and this is the unknown, is that strategy going to be successful, bearing in mind the Fed's tried it for a good few years and failed. The European central banks have also offensively failed as well.
Longer, right? And Japan's been going at it for even longer than that again. Yeah, absolutely.
So the question that I have is, okay, so what evidence is there that's going to work? First question. And the second question is, what's the exit strategy? And at the moment, they're silent on both those things, in my view.
Absolutely. I think the plan is hoping that governments will start spending money. I mean, I think that's where they know that needs to come. You need to. They can't. They've done as much as they can do, or pretty much as much as they can do, on the monetary side. And each little bit they're doing now, they need to do. They need to spend billions and billions more than what they had to spend a few years ago just to get the same effect. And so they really are hoping that governments will step over and step up and really start spending money. But they haven't been willing to so far. And so, and then one more but on top of that is now we've got a new set of politicians in the US, and the Treasury Secretary used to be the head of the Fed. And so, if there's anywhere that's going to get it going, I think the US looks like to be the one.
Well, it's interesting because Yellen's, of course, moved across from her role in the Fed to run Treasury. We've got Mario Draghi, who was, of course, the Euro ECB, now running politics in Italy, and you've got Legrand, who was basically, the World Bank, now effectively running the ECB. I mean, talk about revolving doors.
Yeah, absolutely. And so you would think, you'd think that having been in central banks, there will be a lot more work between the two. And someone like Janet Yellen, you would think that she'll have a good idea about a much better idea about the financial planning plumbing as well. And I think there are ways which you might not see come through in terms of budgets and sort of seen in ordinary printing of money. But whether it's some sort of extra support for local government debt or extra support for state government debt, or subsidies or things like that'll be going on that won't actually officially show up in either central bank government's balance sheets or in federal government balance sheets, and they might actually that type of thing might have a bigger bang than what you think.
That's true, and I also think we should be watching the states because they're borrowing big as well, right? And in fact, the RBA was very keen that the state should borrow big along very low rates, etc., etc. So if you look at the total quantum of debt, okay, the federal debt's going through the roof, but the state debt's following it too. So the total debt pool in Australia is just accelerating massively. Yeah.
And we don't have as much local government debt here, but there's still the potential. That's another you could roll out policies to try and get local governments to borrow more money, and that's certainly something you'll see in the US.
I agree. Now, there's quite a lot of questions coming in. Did you want to run your prez, or shall I go straight to the questions? How do you want to play it?
Let's have a quick run through the prez. I wouldn't mind just setting the scene on a few of these for people and just having a few charts because I think that might spark some questions.
Okay, you're full screen, and I'll leave you to share the screen.
Yep, am I across? No, I'm not. Sorry. Let me try that one more time.
It's in there somewhere because we tested it before. No.
I switched screens and I was busily showing the sides to myself. So now hopefully you can see them as well.
Yeah, all good.
Yeah, excellent. Okay, so so what I wanted to do, have a quick run through Gamestop and not it's obviously been done to death, I think, in most of the media. I'd like to talk more about the longer term implications for Gamestop and what it actually means for a few different markets, so that I think we'll have some changes following it. We'll talk about market valuation. We'll talk about the fourth quarter US reporting season. That's pretty much, which is most of the way through now. It's sort of just kicking off in Australia, but most of the rest of the world has is almost done. I want to talk some vaccine maths, and then I want to talk about this inflation scare that I think is coming later on this year. So, Gamestop, hopefully most people have heard about this one. Basically, a stock in the US that sort of ran up a couple of 1,000% on the back of traders sort of talking on Reddit and sort of all pushing, and a lot of hedge funds lost a lot of money. And I just wanted to highlight it. Look, it wasn't just GameStop. There were other ones as well, as AMC, which is a movie cinemas, and BlackBerry, which is the same BlackBerry you knew from years and years ago that used to run phones. And even GME Resources, which is an Aussie stock that sort of ran up 50-something% because it happened to share the same ticker as GameStop. So it was clearly not it was very much a trading issue that happened, and there was two different two different reasons for that. Two of the main different reasons. One is the short sellers. So basically, what short selling is you're basically betting that the share price will go down, and to do that, you have to go and borrow the stock from somebody and then sell that on the market. So, say I might own the stock, and Martin might think the stock is bad stock. He'll come and borrow the stock from me, and he'll go and sell it to to a third person who also likes the stock. So there's effectively two people that both think we own the same stock, and Martin that owes one of us some shares. And the problem that happened with Gamestop is it actually ended up with more than 100% of the available stock to be what they call the free float of shares out there had actually been sold. So once the share price started going up, if Martin was a short seller, he's starting to get caught having to pay out more and more money to cover his the losses that he's going to make, and that sort of that process means Martin then has to buy back the stock, and because he's buying back the stock, and there's two of us already own the stock, and we don't want to sell it because the share price is going up, he's got to go and find somebody else, and that pushes the share price up to quite high levels. At the same time, there was some quite sophisticated stuff going on in the options market as well. So what's called a gamma squeeze, where it's basically a way of using options to and options is sort of like if you're at the racetrack and you're buying you're putting your money on a horse to win a race. You'll give it to a bookmaker, and the bookmaker's not he's just trying to hedge that bet. So he's trying to find somebody else on the other side. And if lots of people start betting on one horse, then he'll lower the odds for that horse, and he'll start increasing the odds for other horses, trying to get more money because they're not actually trying to make any money on the deal. And options traders are exactly the same, but there was a way you could basically game the system to try and that actually meant the options, the people who you're buying the options from, were actually going out and buying lots of stock as well. And so GameStop sort of had a whole bunch of things converge all at the same time. That meant the short selling pushed it higher, and the options all pushed it higher. And then that meant that more retail traders came in, and then it started popping up all over the place. And Elon Musk came in and told people that he thought it was, if they could hold on, they should. And so that sort of meant that the share price really took off at that stage. And so okay, so that's the sort of background to it. I guess there's a couple of things that sort of highlights, and I've written more on this, and you sort of go in more detail on our website if you're sort of more interested in the detail of it. But I guess the six main things I want to highlight is, look, there are fundamental problems with short selling, and this sort of highlighted a few of those problems, and a lot of it comes back to when there's too much short selling, and we have had a lot out there, but that's certainly reduced as this has happened. So there's a lot of people pulling back the amount of shorting they have. That's not necessarily a negative for the market, because what happens is there's a lot of hedge funds out there who will, or let's use Martin as our example. He was a person who sold the GameStop share that he didn't actually have, so he borrowed it from me and sold it, and so he's actually got the money. He then usually goes and buys another stock on the share market, and so when he wants to close out his short, he actually then closes out the long as well, and so he's basically buying $1,000 in one hand and selling $1,000 in the other, and so it all sort of cancels out. So it doesn't actually really affect the total market, but it does affect some individual stocks. So that's the short selling side. So there's some changes going on there, but I don't really think it's going to a big negative for the market. In terms of the options market, it's going to be more expensive to buy, especially some of these smaller, less liquid names, and so. So the chance of this happening again, well, first of all, on the short selling side is a little bit less, because this is a lot less short selling, and the people who are doing it are very cognizant of running into these same problems, or certainly a lot more cognizant than they were 6 weeks ago. The options market is similar, so you've just seen repricing of some of these call options, and there was a good one of the Bloomberg guys made a good analogy of. In 1987, we saw this stock market crash, and at the time, everyone was sort of using this thing called portfolio insurance, so they thought would bail them out if the share market ever fell, and it didn't work. And so what that meant was people went, okay, that thing doesn't work, but what we saw that put options did work, and so put options, which is basically another type of insurance you can buy on shares. that actually meant that they became structurally more expensive going forward. And I think this is going to do something for call options, and it has so far. That to actually be able to do the things that they did to push GameStop higher is going to be a lot more expensive than what it was before. Excuse me. And so what that means is, it's going to be a lot harder to have this same event happen again. There was a whole bunch of retail traders that were in on it, and they were sort of getting, I guess they're getting this free advice from Reddit, and they get the free trading from Robinhood, and it's one of those lessons about, when something is free, then chances are you are the product, and in both those cases, some of the stuff that's appearing on Reddit seemed pretty sophisticated for a website that's for retail traders, and some of it you would expect is coming from other professional traders, whether that's them doing it because they're stuck at home and they don't have the same compliance regime they used to have, whether it's they're people who are not working anymore, or whether it is actually genuinely hedge funds that are taking the opposite position and then pushing this story out to retail traders to try and get them to help push the share in the right direction. It's nobody knows which of they are, but I think certainly you're going to get a lot more advice on these Reddit forums, and it might not always be in the best interest of the people reading it. So that's one side of it. The other side, though, which is probably the most important part of this whole thing, is that what I think it's really done for a lot of retail investors is it's shown here's how you can win the lottery. And although there are lots and lots of people who have lost a lot of money on this, like there was a lot of people who got into the trade early who made bucket loads of money, but there's a lot of people who got in and bought this stock at sort of ran up from $5 to sort of $400. A lot of people who bought it at $400 expecting it to go to $1,000 and ended up losing a lot of money. So I guess it's despite that, though, what the episode is really showing is this idea that you can stick some money in the stock market. It's a bit like the casino, and you might make millions of dollars on it if you try and find one of these stocks that's going to short. And so I think that's going to encourage more retail trading. Not positive it should encourage more retail trading. One of the ideas of a lottery is it doesn't actually, you buy a lottery ticket for $1, you're not expecting to get $1 back. You're expecting to get less than $1, but you might get lucky and you might win $1 million on it. So and I'd encourage people not to think of trading as that way, or not to think of investing in the stock market that way, in terms of, yes, I'm going to put $1,000 in. I'm expecting actually to lose half of it, but I'm hoping that I might turn it into $1 million. I think there's a much better strategy in terms of putting $1,000 in and trying to grow that to $1,100 over a couple of years, and then $1,200 and keep on going. Excuse me. Prime brokers. So behind the system, there's a lot of there's these people called prime brokers who basically lend a lot of money to hedge funds, and we had a few hedge funds that lost a significant amount of money on this deal, and so prime brokers certainly pulled in the risk a lot on a lot of stocks, and you've already seen this. This isn't an ongoing one. The stocks fell. Other stocks that sort of ran through this same process was because the prime brokers were pushing it in. So I showed you that chart of some of the other stocks that ran up in price. Some of that was because retail traders were out there pushing that as well. But some of them was because the prime brokers went through their book and went, hey, here's another stock with a problem. If you've got a short in that, we want you to halve the level of your shorts or quarter the level of your shorts to reduce the risk. So they certainly learned something in the short term. The problem is what they probably learned. So the first short-term thing is, yes, we need to go back and go through all these risk characters and pay attention to our risk parameters. But quite possibly as well, what they might take out of it is, hey, the market went through this huge disruption and nobody really fell over. Yeah, some people lost some money, but net, the market handled it. So therefore, everything's fine. We can get back to lending and increasing risk again. Exchange traded funds. So it was a reminder of some of the risks in the exchange traded funds. So because exchange traded funds tend to buy stocks without regard to valuation or anything, they're what we sort of call a price insensitive. So basically if it's part of the index, they buy it. What that meant was you might have been buying some exchange-traded funds over that time period, thinking that you were getting some, like I think it was the S&P retail fund. You're thinking you're getting like a nice diversified exposure to a whole bunch of retail stocks in the US, and you're actually getting a 20% plus exposure to this one company because it had run up so much in price. There was another one that was actually called a value fund. So and because they only rebalance every now and again, every sort of 3 months or so, when it had rebalanced, this stock looked like a value stock. But if you're buying it sort of in late January, all of a sudden, 15 or 16% by far and large, way the largest stock in your value portfolio was this stock priced on a huge multiple of its sales and could never expect it to make the value that it was worth. So that's sort of the 5 effects that I think that are going to go forward. But it's also worth noting that there's so much stimulus and so much government push sort of push for liquidity out there that this was a relatively serious test of the financial plumbing, and it's going to happen again. And so it won't be the same. The gaps that you've seen in this one will be plugged up, or risks will change, and the amount of leverage, amount of debt that's out there will change. But you're pretty certain to see another go at this sort of financial planning, financial plumbing. Should I? I went up for a lot longer than what I thought I was going to go for on that.
You
part.
did.
Should we?
Why don't we? Yeah. Why don't we? Yeah. There's a bunch of questions building up. So why don't you drop your screen back? But I mean, that's a really interesting conversation, because I think people need to understand the multi-headed nature of what happened with Gamestop, right? And it isn't just one stock, right? As you say, there's quite a few, but it revealed a lot about the way markets actually work, and the fact that there are a lot of cross currents that people don't assume to be there that are there, right? And there are players with big amounts of influence and funds on both sides of the equation, and we don't even know whether in fact hedge funds were on the other side of the trade as well, effectively, as you say, joining forces with some of the retail buyers to drive it.
Yeah, and joining forces sounds like it's a nice equal division of the power. It's if there was hedge funds behind it, which there's a pretty decent chance it is, then it's them sort of leaking out, hey, here's an interesting strategy. Hey, did you know if you bought these options and those ones, then this would happen, and those types of quite sophisticated the gamma. It's not the ordinary investor doesn't think of a gamma squeeze when they in terms of trying to push a share price higher.
No, exactly right. And I just remind everybody that for every winner, there's a loser, right? Absolutely. And so some people may have made a lot of money, but that means that somebody else somewhere lost a lot of money, right? It's a zero-sum game.
Yes, and there's a lot of people out there who made a lot of money on paper and lost a lot of money on paper and ended up back, not far off where they first started. Yes. Because they looked at this thing and went, hey, it's gone from $5 to $400. Maybe it can go to 1,000. Maybe it can go to $1 million. What's to stop it? When you don't care about valuation, what is just a number.
And the other thing I just comment on, Robinhood, is an interesting example. They were effectively tripped up because they didn't have the liquidity support they needed to be able to continue, right? So they had to actually turn trades off.
Yeah, so they so I mean, there's lots of conspiracy theories floating around about hedge funds and whether that was that the hedge funds got Robinhood to turn basically just to stop letting clients buy this stock for long enough for them to close out their shorts and things like that, which might be the case. I don't think so though, because Robinhood had to raise about $5 billion because they were being the stocks that they're buying stocks in a weird sort of account as well. It's not a normal account, which is why they get to do everything for free and everything like that. And so what it meant was, as everyone was buying, and all of a sudden this stock, which would ordinarily might go up 5 or 10% a day, and so the person who's behind and who's getting Robinhood to meet the margin sort of says, okay, if the stock can go up 5 or 10% a day, I'm going to need this much money from you today, and then the next day I'll need a bit more or whatever. And now all of a sudden the stock's going up 300 or 400%, and that person just said, well, I'm not going to take it anymore. You need to pay me up front if you want these. And so, it's there's conspiracy theories around, but it's quite possible that it was just a genuine risk management on behalf of the agencies behind it.
Hard to tell. Now, Vanessa asked a question earlier on, which I just want to throw up because it's really quite relevant. Do you believe there is a collateral shortage, and what does that mean for the markets? Because in a way, that's what we saw, wasn't it?
Yeah, I don't think there's a collateral shortage. No, I think there's plenty of cash floating around, and plenty of there's. It was more that the volatility increased so dramatically that people needed to increase the collateral they required. So, and I'll put this in an example. So Martin's buying a stock from me, and he buys a stock for $1, and I say, okay, well, he's got to give me the money in 2 days' time. So I'll make sure he posts 10 or 20 cents first, because if the stock moves against me, if it moves 10 or 20%, then I can still, and I've got his first 20%. I can go sell the stock on the market, and I won't be out anything if Martin reneges on the deal. Whereas now this stock was going up hundreds of percent, and they just went, well, we're not going to, if you want to buy a stock for $1, Martin, we need the dollar up front. So yeah, so I don't think there's a collateral issue, but it does. What it did show though is that it's this whole idea that when there's so much liquidity out there, so much debt out there, and so many people chasing, the latest, whether it's Bitcoin or Gamestop or the latest, get rich quick scheme, it's going to test the financial plumbing, and you do have to rely on financial market regulators stepping in and making it right. And I don't know that, I expect they probably can, but you can't rule out the case that they could make a mistake, and the next thing you know, you're looking at, one of the big problems with letting Lehman's fail was and not winding it up in a more orderly manner. Not to saying, I think letting it fail is fine, but the way it was wound up is that there were so many different cross parties that nobody knew what was going on, and everyone just went, well, I don't know if anyone's got exposure, so I need to pull back.
Absolutely. I just want to put this chat up because I'm not sure I fully understand it. But Dylan says, thanks for the super chat. Another $20 of Cookie Boy unblocks me and explains why he did in the first place. I have no idea what this is about. But anyway, thank you for the $10. So you get your super chat shown. So thank you for that, Dylan. Appreciate it. And I want
and a shout out to Cookie Boy to double it.
Exactly, right. Exactly. Yeah, go for it, Cookie Boy. Now, Master Singleton asked this really interesting question, which sort of builds on nicely, which is, what do we think about the increased popularity of retail trading and how this affects the traditional institutional trading that our superannuation funds rely on? In other words, what's the real impact on the super sector?
Pushes prices up. So I think it's similar to what you saw in the tech boom, is that retail investors tend to be less concerned about price. They're buying a stock because they like it, or because they've been told to buy it, or because they think it's going to go up, whatever the reason is. Whether it's at $10 or whether it's at $20 or $30, I don't think they look at it and consider that. Whereas I think most institutional investors, hopefully most, have a look and go, okay, well, I really like this stock at $10. But you know what? If it hits $30, I'm out of here. It's just not worth the price. Where I think retail investors are less sensitive to that, and so you probably will see more volatility in terms of the individual prices. I mean, another interesting one on the rise of passive funds that sort of wasn't caught out or has been missed as well is that passive funds, so exchange traded funds and index funds, who basically are similar in that they just buy one of everything, well, effectively in the size that's in the market, and they don't care about the price. They're again just saying we're just going to buy it. Is the rise of these ones has meant that because they're buying more and more of stocks over time, like it used to be 3 or 4%, now it's way higher than that. The strict indexes is probably closer to 20%, and then if you count all the people who sort of do some other semi stuff, you can probably double that again. It means there's less shares out there available for people who do care about price to buy. And so when you do I don't think that's necessarily a terrible thing, but it means you can get more volatility in these cases where you all of a sudden get a flood of retail investors jumping on saying, we don't care about the price, we just love the story, let's buy it. And that can push it up because there's just not as many shares out there to buy.
And I guess, my perspective would be that some of that trading behavior is much more akin to crypto land, right? Where basically you're buying momentum, you're buying the expectation that prices will go on rising, irrespective of any fundamentals. And you might be right, you might be wrong.
Yeah, absolutely. And as I look a lot at quantitative strategies, which is mathematical ways of how to make money, and we tend to pick on value, which is trying to buy stuff that's cheap, and quality, which is trying to buy stocks that are good quality. With the idea that you get an intersection of those, and that helps give you a nice return over the longer term. A very common alternative way is called momentum trading, and that's really what's taking over in all these, where basically you buy what's going up and you sell what's going down, and those strategies are surprisingly effective. But their payoff tends to be, there's a couple of elements you need to keep in mind. Is you tend to make little bits of money on it, and then all of a sudden you give up a hell of a lot because you get the momentum wrong in it, and the stock gaps down or does whatever. And Gamestop was, well, probably not, a decent example of that in terms of some of the falls you saw. But it is worth remembering that that type of behavior feels really good because you make lots of little bits of money, and then all of a sudden it doesn't feel as good anymore when you lose a lot. Whereas trying to go for strategies that are a bit more let's just call them safer, a little bit more less volatile. Let's call it that way.
Yeah, and of course the other alternative is to let it go up a certain amount and then sell, basically to anchor that growth, right? But then of course you've got all the capital gains and other things to deal with as well. So that makes it quite complicated.
Oh, it's a tough problem to have all those capital gains, but I'm sure you can live with that problem. But finding the stocks is it is a high turnover strategy though.
Yep.
But in terms of that, so you do have to, if you're going to follow one of those strategies more strictly, like the funds that would do it would turn over at least 100% of their funds a year, probably more. Like some of them will be like, might turn over their funds 10 times a year. So they are very high turnover rate, and you can change your tax status if you trade out there trading that much, which can create a.
Now, Greg asked this question. Ask Damien, are you increasing your cash holdings just yet, and what signals are you watching that would affect that investment decision?
Yeah, look, so we've got, I'm defensively placed in terms of I'm not fully invested in everything. I'm watching a number of different signs. I think the biggest ones are stimulus, and particularly in the US. Like if we start to see that fall through, but all signs look pretty good in terms of that. I think there's bankruptcies is the other one. I'm watching quite closely. Is will governments and start kicking people out of houses if they're not paying their rent, start making them pay their interest and those types of things. I think it's going to be very gradual. And I think that all the evidence globally to that is that with the vaccines now, 6 months away from rollout or 12 months away from sort of being fully rolled out, governments are just extending those. So we're not going to see the bankruptcies. So bankruptcies is the key one I'm looking for, and stimulus payments. And then the other thing is just looking for policy errors and things like that.
We should touch on policy errors because the stakes are getting higher, right? The amount of quantitative easing is rising. The amount of government debt is rising. The long-term debt status of the country is being impacted by all of that. So because they're dealing with larger amounts of money, two things. If they make a mistake, it's going to be a bigger mistake, right?
Yep.
And secondly, if they're following what everybody else is doing. So my theory is that the Reserve Bank had to do what they're doing because of what the Fed had done, right?
Yep.
So if somebody in the US makes a mistake, a policy mistake, we're going to ape it. Right?
Yeah, quite possibly. Hopefully we move far. I guess we've been a long way behind a lot of the other central banks. I think the RBA has come quite quickly, brought itself up quite closely now. So, if we're talking 3 or 4 years ago, well, I'm saying yes, we're aping them, but with a 3-year lag, and so it doesn't, we'll get to see the problems. Whereas now, the lag's a lot closer. So
well, they had to because the exchange rate would have gone through the roof, wouldn't it?
Yeah, absolutely. And I think they've been talking quite candidly about the errors they've been making, I think, which is sort of better than a few years ago when it was all about, no, this thing's going to, yes, we've got it wrong the last 3 or 4 years, but it's all going to come good. Just wait and see. Whereas now they're actually sort of doing a bit like, well, okay, we got it wrong. And what I'm quite pleased to see is they haven't just said we got it wrong. But if it wasn't for the coronavirus, I'm sure we would have been right. They've actually done enough navel gazing to go, okay, we got it wrong and we were consistently wrong. Maybe we do need to do something different.
Well, and those charts that keep showing the projections on wages growth and everything else and inflation and what actually happens demonstrates that they continually get it wrong. So, the emperor has no clothes with regard to that. So I think they had to come clean a little bit in terms of saying, well, we have not necessarily read it right. The question, of course, is, are they reading it right now? And I still think that the risk of policy error ahead is still pretty high.
Yeah, absolutely. And I do think while there is a lot of government stimulus in Australia, I don't think it's very well targeted at all. I think there's targeting businesses, targeting capital expenditure from businesses is not a good way, because the businesses will spend the money offshore. So if they're buying they're spending money on capital expenditure. We've already seen the amount of bonuses and things like that they pay themselves. Businesses are doing pretty well I want to talk profits a little bit. We'll move on to, we've got some slides on that. If you want to get money out into the economy, you give it to the poorest people.
Yep, absolutely. Well, unfortunately, a lot of the JobKeeper went to the big end of town and they've turned out big profits and bonuses, and only a small number of those companies have decided to pay it back. So I have a problem with that, frankly, but that's a more a moral than an economic problem.
Yes, absolutely. So let's keep going though. So before then we'll
let me just go full screen. There you go. Okay.
So market valuation. Yeah, what I wanted to do quickly on this bit, just to put it in perspective, it's a little bit of a complicated chart that I wanted to explain to you. So this is the price to earnings of the stock market. So it looks at stocks. If a stock's worth $100, what are its earnings? How much earnings is sort of backing that up? So the higher it gets, the more expensive it is, and the lower the cheaper. And what I've done is looked at the last 20 years, so we can sort of see the tech boom as well. And I've broken it up into percentiles and said, well, the top line is how expensive was the top 10%, the most expensive 10% of companies. So you can see in the tech boom back in the 2001, they sort of got to over 50 times. Oh, sorry, one other thing. So what earnings am I using? So you can use the actual earnings that the company had. What we commonly do is we look at the forecast earnings for the next 12 months and put that in. Because of all the distortions with coronavirus, I've actually taken this one step further. I've actually said, well, ignore the next 12 months as well. Let's look from 12 months out to 24 months out. Not because not because I think analysts are particularly good at forecasting these numbers. That history's shown that they're not, but it does give us a much better feel for. We don't have any of the distortions that's happening on with earnings and depressed earnings and growth rates and things like that. So we're a much cleaner look at how this has travelled. And so you can see back in 2001, got to the top. The most expensive 10% was you'd pay 50 times what it was earning. So if a stock was earning $2, you'd pay $100 for the shares. Back throughout most of the 2000s, it was closer to 30 times. And now we're back up pretty close to 50 times. So the most expensive part of the market is expensive. And you can see all those lines are a little bit higher than what they ordinarily are. And the grey area sort of shows where half the companies sit within the market. So that's sort of, at a headline level, we go, yes, the markets are expensive. It looks a lot like the tech boom, and similar types of dynamics. What I wanted to zoom in, though, is what I've got here is the cheapest 25% of stocks. And it's a similar chart for the cheapest 10% of stocks as well. But what it's showing on these ones is if you look relative to where they've traded over history, they've sort of traded around that sort of 11 to 12 times for a lot of it, sometimes lower, sometimes higher, but they're not that far away from their longer term history. And what that's saying is out there within the market, although in general stocks are expensive, there is this cohort of stocks that are relatively cheap. compared to their longer term earnings, and that's pretty much sorry, double up on that chart. And then what happened in the tech boom? So I've got a chart here now of the tech at the end of the tech boom as it finished, and you can see that the dark blue line is what the Nasdaq, which had all the tech stocks in it, did. And then the light blue line is the MSCI World Value Index, which is where all these the types of stocks I'm talking about. And so for the first sort of 6 months or so, as the tech boom finished, you saw that the Nasdaq stocks sort of fell 40-odd%. At the same time, these value stocks actually rose over that period, and so it was really just the stock market itself basically didn't go anywhere, and you really just saw this whole churning as these value stocks performed well, and then the real growth and the really expensive stocks really took a tumble. And following that, then you started getting into recessions and other things like that, and the whole market did fall. But we're expecting a sort of similar type of outcome from this. Is that at some stage, what we're going to see is we're going to see that leadership change, and you will see that all these stocks have been bought up on the back of a great long-term story or hope. Will start coming back as economic realism sort of starts to come back into fashion. And one of the stocks I love to talk about is Cisco, which was one of the great stocks of the tech boom. Its earnings basically from 2000 to up until today, its earnings have increased like 6 times. It's actually been a very solid company from a earnings perspective. Like just every year they come in with more growth, and you look at the earnings number and you're like, what a fantastic story. The stock's still 50% lower than what it was in the 2000s because the price just got so high that you can't value it. It's just the valuation side of it made it fall sort of 90% or 80-90% first before it sort of rose again. And that's what I'm talking about with a lot of the stocks out there today. Is you might have a view on a stock that's it's the greatest thing ever, and its earnings are going to grow fantastically over the next 20 years. But if you're paying 300 times earnings on it, then it might never grow into that valuation, and that's the issue with the we're sort of seeing in terms of valuation issues at the moment. So that's valuation side. While I'm on that, I should flick to fourth quarter reporting season as well. So it's been really good. So I've got a similar type of thing now. I'm just looking at. There's about 700 or 800 companies around the world. These are all large cap companies, so all sort of equivalent to the top 60 or 70 stocks in Australia. And so fourth quarter this year versus fourth quarter last year at the 50th percentile was 9% higher. So and fourth quarter last year was pre-COVID. So that was you're doing well. It's been a great performance for companies in that basket. In terms of surprise, that's basically what did people think they were going to earn a month before they reported, and then what did they actually come out with? And so that was 13% higher than what they thought a month earlier. The net NTM revision is basically what did they do to earnings? So they revised earnings upwards for the next 12 months, and there's been like a 5% upgrade. If you look at the next 12 months versus 2019, they're sort of 6% higher, and 2022 numbers have been revised up as well. So in terms of a reporting season, they don't get too much better in terms of the stats. Quite often, especially some of the later term numbers, almost always get revised downwards. So what we usually see is that analysts are too optimistic in later years, and then every time you get a reporting season, you get some downgrades to the later year numbers. But that didn't happen this time, and so just to contrast, very expensive markets, but profits are certainly growing strongly from companies at the moment. Is that one? Should we go to questions first, or should we get into vaccine?
Yeah, there's a few questions. Then we might come back to the vaccine perhaps towards the end of the conversation because So there was quite a few questions that let me just try and pick them up. Okay. Well, let's just pick this one up from Sir Cookie Boy about JobKeeper. Right, we know there's 1.6 million people, according to the Frydenberg op-ed that was published in the Australian, which was quoting ATO statistics that hasn't been fully published. Very frustratingly, I wasn't able to get any more detail on that. But 1.6 million compared with the more than 3 million at the peak. Now, that's going to come to an end at the end of March. And so I guess the question is, what's the implications of that? And maybe they're going to extend it, maybe they're not. But it seems to me quite an important conversation, because it does have an impact, not necessarily on the big ends of town, but on a lot of smaller businesses.
Yeah, I think, look, my experience has basically, and I think the experience of the last year sort of tends to show as well, is that companies go insolvent, especially smaller companies, when they absolutely have to. If they can hold on to some hope and just they can be lent a little bit more money, or they can get extended on their on their overdrafts or whatever it is to keep them going. I think they will, and I think that's what we've seen from a lot of companies over the last the last year, that you stop paying interest on your mortgage, you get the JobKeeper to help with your staff. There's there's various payments and grants sort of that have been given out. You might have been able to borrow some more money, depending upon your. Not that the banks actually lent much of it, but yeah, there's all these other things people will do before they give up on their business. Possibly at the end of March, as you'll start seeing this start to leak into the market. I actually think it would be a good thing to actually start, because, and I think even for when people say, oh, but what about the poor individuals? Look, some of these guys have been hanging on for a year now, hoping that something's going to turn around and make it better. And if they're running a restaurant that's still only back at 60 or 70% capacity, and they just can't afford the money that's from it, for some people it's or for a lot of people, I think it is actually it's helpful for them to actually get to cut it earlier, and then they don't have to put more people. They don't have to get their suppliers running into debts and creating more problems out there, because the problem you can have is that one person who's really struggling for cash flow and keeps borrowing from or not paying their suppliers and switching suppliers, and you get enough of that going on, and the next thing, all of a sudden these suppliers have got problems, because and then you have a much bigger problem.
The network effect.
Yeah. So I am concerned about it. I do think, though, it's going to be punted further down, 6 months down the track, because vaccines are almost here. We can see the light at the end of the tunnel, and if governments can, they will.
And I'd add just to that, I spoke to 2 insolvency practitioners over the last week, both of whom had a massively quiet time for the last 9 months or so, right? Because, of course, the government allowed directors to trade insolvent and businesses to continue. Yep. They've both said to me that they've now started to see a spike in people making inquiries about what to do with regard to insolvencies and with the changes in the legislation that came through, because it's now an easier process.
Yep.
And both of them said to me independently that they're expecting a boom of insolvencies, but not in March, but about September, because it takes that long for the process to run.
Yep.
So we've got a little bit of wriggle room, and then if government does throw some more money into the system, whether they pick industries like tourism or whether they pick geographies like Victoria, I don't know.
Yep.
I suspect they will do some more of that, because clearly there are still businesses which are in great difficulty and will continue. But I'm not sure I'm going to expect to see an absolute cliff at the end of March. I think this is going to be a slow creeping process, but I am expecting unemployment to rise later in the year because of it.
And I think the housing market's quite positive for resolving this issue, because a lot of small businesses, most small business loans are against a house. Banks just don't lend against businesses, and so given the housing market's been quite strong, that's a huge bonus for anyone trying to work their way out of problems. And
absolutely. With rates, of course, ever so low.
Yeah, I mean, a good soft landing scenario would be that the next 6 months are spent small businesses selling houses. People who have lost their jobs selling houses, sort of gradually over that period into a quite a strong housing market, rather than all of a sudden it all dumping onto the market all at once and snowballing and getting away. So that's what we're trying to weigh up now. I think our initial thoughts, sort of pre-vaccines, were that at some stage, we thought about a year would be about the right time. They'll have to start giving up and just taking it. But I think there's enough now to suggest that it probably will get drawn out for a bit longer.
Yeah, watch this space. Now, one of the other questions I had, this is actually one that came through beforehand, from Felicita. And she basically was talking about superannuation and the options within funds within superannuation. So she's in a particular fund at the moment. There are various options that she could pick. The question was, how do you determine which type of superannuation fund is optimal? And, all the various options and, growth funds versus not growth funds. It's a real complex area, that, isn't it?
Yeah, it is. And there's some sort of limited in terms of what I can say. Obviously, I'll say again, this is not personal advice. So, yep. And if you want, we have tools on our website where you can run through, and that's probably a good way of, you run through a risk profile is a good way of actually getting to the stage of saying what risk matters and how soon do you need the money. So I guess the issue is if you will lose sleep over losing $1 of your superannuation, then you can just leave it all in a cash, and you won't. You'll get terrible returns, but you can sleep at night because you know it's not going to go down. If you've got a long time to run and a higher risk profile, you can sort of sit at the other stage and be almost all invested in shares, or in some cases you can be all invested in shares, and you'll get a very volatile ride. So the last year, you might have fallen 30% and then risen 30%, and so you might be square on the whole thing, but you might have started with $100,000, seen it fall to $70,000 before bouncing back again. And so if you're willing to take those, the more risk you're willing to take, and you have a long time to carry it, you can afford to have those and live with the drawdowns. The problem is if you're close to retirement and you need that money to live on, and one day it's 100,000 and the next day it's 30, that's going to make a big dent in your retirement. So as you get closer to retirement, you need more and more bonds and less cash.
Well, it used to be the old rule of thumb that as your age increased, then you pulled yourself out of the market into other more stable returns because you need more certainty as you get older. Yeah,
that's right. And the only the extra level I'd put on that as well is and it obviously depends on how much you have as well. So if you've got $20 million and you're looking to maximize the amount you can give to charity or give to your kids or grandkids, then you can probably afford a higher risk allocation. But if you've got your last $200,000 and you need to make that last to the end, then there's obviously a lot less risk you can take as well.
Absolutely, but there's no simple formulation. I guess that's the point, right? That you try and sort of balance risk, duration, how long you need to, how much you can afford. And I actually think how much can you afford to lose, and that's both financially and psychologically, right? Because there are people who are just horrified if they see their superannuation balance move down, right?
Absolutely.
Others can live with it. So that's a psychological aspect rather than just a financial aspect.
Yes, yeah, absolutely.
And by the way, having lived through 4 property cycles in the UK, where I lost money on 3 of them, I know that prices of property can drop too. So,
not Australia though, is it?
Oh no, not in Australia yet.
That's right. That's something we've heard about overseas.
Yeah. Okay, now Jason's asked this question, which is quite interesting. It's about AI, artificial intelligence. Other algorithms apply to stocks as well as to crypto? If so, couldn't they be defeated by introducing something they haven't yet learnt, like the GME type thing? And I guess there's 2 parts to it. How much of the market is algo-driven, right? And when you get this sort of insertion of something new, like GME, does it mess it all up?
Yeah, look, there's a whole bunch of different things going on with artificial intelligence, and there's different timeframes as well. So there's some stuff that happens at the really fast trading, which is like where everything's in milliseconds, and it's basically trying to front run other people's orders or trying to work out. People have trading systems where if I want to buy $10 million worth of stock from a particular stock, the person who I place a trade through will break it up, and they'll try and they'll try and put the stocks out randomly and try and trade that so that other people don't work out, hey, Damien's trying to buy a lot of this stock, bid the price up and see if we can front run him. And then there's other machines out there that are trying to work out what my machines are doing. And so there's a lot of that on the trading side, which all works at one side, which is really just about trying to beat other people in the game and trying to game the system. In the end, there's not adding any value at all, I don't think, to the whole system. If they all disappeared, I don't think other people would really notice. There's a section out there which is trying to of AI, which is trying to then forecast share prices, and a lot of that's using these momentum type ones as well, and they need to be continually trained and continually updated, because what happens with the artificial intelligence stuff is it tends to way overfit the problem. So it's sort of, you tell it, okay, here's 20 years worth of data, and your example there is great. It hasn't seen a Gamestop before, or it's only seen, there was one back in the Volkswagen happened 20 years ago or whatever, and so it won't automatically work that out and take it out. And there's other things as well that happen over very long periods of time. We've seen interest rates fall from 20% to nothing, and so there are that sort of drove stocks in a certain way. And so if you haven't factored that into your model, and there's other other bits and pieces. So artificial intelligence, we've got a number of different ones we use on those fronts, but we tend to use it as very rough guides, and it's almost there. It's there to see if there's something interesting, rather than as there's something interesting you've missed, as opposed to here's something you have to rush out and do.
Yeah, it's interesting because I did a couple of quite big projects with some very smart university people who are experts in AI and running machine learning. Right, what they were trying to do was to essentially replicate the segmentation analytics that I do in my models and see whether they could automate it. Right, and we had a competition over 12 months as to who was more accurate at the end of the 12 months, and I came out way ahead. Right. And their excuse was, well, this is all new, so you got to run it for a lot longer to be able to actually learn more, more about. But the point is, it's a fuzzy, complex set of interrelated elements, right? It's not just one thing or two things or five things. It's 30 to 50 to 80 things, right? Yeah. And in those situations, sometimes those AI mechanisms don't actually necessarily do that well. And I wonder whether there's a parallel there with some of the machine learning that's used in Stockland as well. Yeah,
and there's so much data out there that and some of these machine learning tools, really, you don't know why it does what it does. Like we need to have to keep coming back to why, because you might find out we've just built this system that buys stocks starting with the letter T on a Thursday at 11 o'clock, and it's got this great track history over the last 10 years, and you're like, well, yeah, but that doesn't sound like something that's a sustainable advantage, if we keep buying stocks with the letter T on a Thursday. But that's what the machine learning found, by tracking it back through and whatever. And so those types of, that's the
well, I used to teach capital markets years ago, and I had a trader who I remember him saying, I don't believe in all of this, all this chartism and all this sort of prediction. I think it's much more random. And he said, just give you an example, for a month, I actually determined whether I would buy or sell, I think it was trading particularly currencies, based on which side of the road my dog decided to actually relieve himself.
Right. Excellent.
And he actually produced a better return.
Yeah.
So there is a certain degree of randomness in all this that perhaps people sometimes would prefer not to take account of, but there you go. Now, Greg threw this question, and it's one which we might come back to, because I know you've got a chart, but it's about inflation expectations, right? Are strongly or widely held inflation expectations capable of causing significant broad-based inflation? And I guess that takes us to a broader question about inflation. What inflation? And, maybe there will be a bit of inflation in the short term, but maybe it's not structural.
Yeah. Let's jump to that chart that I wanted to show.
Yeah, do.
Make sure I can share it this time. Sorry. This time I'll actually hit the share screen. And so we'll skip past the vaccine maths and go to the inflation. So I just wanted to show a chart of an economy with this blue line. Let's say coronavirus never happened, and you're sitting in this economy that's got very weak inflation, so 1.5% inflation per annum. So this is the line that you're on, and the chart below shows the blue line. There's my 1.5% inflation coming out. And then let's say that actually fell. So we have coronavirus. So that coronavirus hits, inflation falls by 1.5% first, and then it just returns back to where it was going to be, if it had just kept on going up in this weak environment. What that would actually mean is you would get 4.5% inflation for that 1 year or that 1 quarter or whatever period you want to show, and that's coming. Like that's coming in the next in the next 12 months. We're going to see inflation prints of significant numbers and there'll be various sectors of the market that are up by sort of 4, 5, 6% in terms of inflation, and everyone who warned about inflation for the last 10 years is going to get their moment in the sun, and they're going to be able to say, so even if you are in this sort of economy that's got this really low inflation of 1.5%, and you just you just can't get inflation again because of the way things are set up, it's going to look like there's inflation, and so we think there's actually, for the markets over the next 12 months, we're going to see an inflation scare, and we need to be sort of ready for that within portfolios. That's one side of it. The low base, that's sort of this, what I'm calling the low base effect. The second part is saying, well, where's inflation coming from? So there's what you call cost push inflation. So your costs are increasing of your commodities and factors are going into it, and so therefore you need to increase your prices. And the other one is your sort of demand sort of pull, where you've got too much money is out there trying to buy these goods, and so everyone's competing to try and buy scarce resources and pushes up the price. In terms of the cost side, we think most of the cost problems we're seeing are due to problems in the supply chains, as opposed to a structural problem that the world can't produce enough, whatever it is, cars or calculators or iPhones or whatever at a price that's acceptable to people. We think that we think that the cost base is actually very, very flat around the world, and the manufacturing that's available in places like China and most of Asia they've got lots of spare capacity, and so they can actually manage lower costs. But you might get a bit of short-term either problems in the supply chain or the fact that people used to order 100, they fell to 80, and now they want to order 100 again, or they want to order 120 of whatever they're ordering, and the factories just aren't set up at the moment to do it, and so they need to go out and hire some more people and get them back to the same capacity. And so again, I think that's a temporary. So you might see a spike over the next year from some of that, but I think it'll be quite temporary. The demand side, look, most of the demand is coming from government stimulus. We do still have the demand we tend to think of as very much an inequality factor. When money is quite evenly spread out amongst populations, then you get lots of demand because everyone's got a bit of money and want to do things. When you start getting quite when you start getting a lot of inequality and a few people are ending up with most of the money and a lot of people are quite poor, then the people that have the lots of money tend to save it, and the people that are quite poor can't afford it. So you get quite weak demand, and that's where we've seen ourselves for the last 10, 15 years, is that very weak demand, and we're not seeing any change to that. So that you might get some extra demand over the next year again because of government stimulus, continued government stimulus, but again, we just think that's temporary. So we can sort of see all three of those factors coming through to providing this sort of one-off sort of look like there's inflation coming. And at the same time, we'll have all these people who are going to hit the airwaves telling you about how bad inflation is, and central banks are finally caused inflation, and it's look out. But we think that'll be a scare that'll sort of fade off, and then we'll be back to the sort of this low inflation, unless we start seeing considerably higher spending from governments. So Martin, does that cover it?
I think that's great. And just to sort of come back to that, right? I think both you and I would probably say that the chances of the rabid inflation that we had in the 70s, which some people are talking about returning, right, would require interest rates to be considerably higher than where they currently are. And I don't see there's any way back from where very low rates are at the moment. In fact, they could go negative rather than positive, right? And the demand side is just not there. And nothing that I'm seeing in terms of government policy is going to change that other than more stimulus into the public sector, which is a bit artificial.
Yeah, and the debt itself has become the problem in that if you start raising interest rates, then all of a sudden you are going to smash inflation because you're going to take away all this money from people who have all this debt. Yeah. And actually, sorry, can you? The actual question though had a nuance to it that I thought what was the actual question? No, sorry.
Got to try and find the question again. Hang on, there's quite a lot in.
There was a nuance to it that I thought was worth. Oh, there's expectations. Yeah,
yes,
there was a question about expectations.
Yes,
that's saying, look, can widely entrenched expectations cause inflation? Absolutely. If you get enough people thinking that inflation is going to happen, then they'll need to go. Then they'll start negotiating higher wages, and then you start getting some wage inflation going, and then businesses then start putting up prices because they're expecting employees to want more money, and you end up in this cycle where that takes hold. I think in financial markets, there's a fair bit of thought that inflation is coming. In the real world, it hasn't, though. And the issue that I have for that, even like we've got our Reserve Bank is telling people, you need to start paying people more money, and they had their own union trying to get pay rises out of them, 12 months ago, and they couldn't get pay rises out of them.
Absolutely.
Our federal government's saying about the same thing, is like trying to cap, the rises for public servants, is actually saying, no, you guys need to get out, show the way. If you want to get wages inflation up, you can't say, well, yeah, let's get wages inflation out for everyone except my employees, because then it becomes entrenched. And I think it is entrenched now that there's just not, you're not getting the wage rises just for turning up and doing your job, which back in the 70s, that was the thought, is that there is inflation coming, so I need to see a wage rise of 5% because inflation is going to be 5%.
Yeah, and some commodities are definitely up, all right, at the moment, and we also know that the official CPI is understating the costs of, for example, housing because of the way that the CPI is created. But nevertheless, structurally, I'm not convinced that we're going to see rabid inflation anytime soon, and that has implications then in terms of portfolio construction. Where you put your money, where you don't put your money. Versus gold, silver, and those sorts of things, right? Because if you believe there's strong inflation, then people will say that gold or silver is actually a really good hedge against it. If there's deflation, it may be less so. The other point to make is that ever lower rates is deflationary, not inflationary, right? Yes. By definition.
Yeah, that's right. And there was a question about the oil price there. Look, certainly the oil price in the 70s was one of the key drivers of inflation.
Yes.
Could the oil price spike higher again? Maybe, but there's much more limits on it now. And the OPEC's got a whole bunch of spare capacity. Shale oil in the US can come on quite quickly, so you could see short-term spikes in prices, but hard to see that lasting for very long. And electric cars are, if oil prices were $200, then electric cars would be way more attractive than what they are at the moment, as a way to avoid that. So that's a natural cap that's going to have on the price of oil. And
of course, the US is a net exporter now.
Yes, that's right.
That is a really big switch from the 70s.
Yes, they're a beneficiary of it.
Yeah. Okay, another interesting question here. Negative rates. We should touch on that. Lowe has basically said negative rates are very unlikely unless something else happens, right? Powell in the US has said negative rates are very unlikely unless something else happens. Negative rates are running rife in Europe and the Eurozone already, and they're in Japan. And the Bank of England has said, well, we're certainly considering, and banks should be thinking about preparing for that eventuality, although we don't think it's very likely at the moment. I guess the question is, what's your perspective? Is it likely, or do you think we're going to avoid the negative rate scenario?
Well, I think this inflation scare is going to make sure we avoid it over the next 6 to 12 months. Then it comes down to government stimulus. If there's enough government stimulus, then we can avoid it. But if there's not, then we're headed for negative rates as well. So but I don't think it's a 2021 case, because I do think we'll get this inflation scare, and so we'll have negative real rates. And so what I mean by that is, if inflation is 2% and interest rates are 2%, you effectively have a 0% real interest rate. If your inflation falls down to -1 and your interest rates still stay at 2%, now you've actually got a 3% interest rate, because a real interest rate. But we're expecting it to go the other way. So we've got interest rates almost 0, and inflation sort of 1 or 2%. If inflation rises to sort of 3%, it's going to, and we think it's only happening for a short term, but it's going to look like those rates the real rates have become a lot more negative.
Yeah, I think that's exactly the way I'm tending to read it too, and it's quite a fascinating phenomenon. But there's also a lot of rubbish being spoken about inflation around the place.
There is an incredible amount of rubbish being spoken about inflation, and it's So just to put it in context for people, there was a back in when Bernanke, so back in 2008, when Bernanke was starting all these quantitative easing, a whole bunch of economists wrote, an open letter, and quite serious and well thought of economists all wrote this letter basically saying, you're putting us on the path to Weimar Germany and hyperinflation and all these things like that. And none of those came true for the reasons we spoke about. Is that, when you've got too much debt, it's deflationary. Cutting interest rates is deflationary. You've got your supply chain. You can basically get stuff produced anywhere. I didn't speak a little bit about, but there's less manufacturing, more services as well, and that means that wage inflation is more important. So there's all these factors that are holding it down.
Absolutely. Yeah, interesting, isn't it? Now we'll just touch on gold a bit more. From Jessica, is it good to buy gold? And I guess that's an it depends answer, I suspect.
Yeah, that's right. Look, we've got some gold in our portfolio. We've got way less than what we had in the middle of last year. So I like it less than I did then. Look, if people believe the story about inflation, then gold will probably go up. It hasn't really yet. So there's that part. I guess there's the other part of gold's very much a currency as well. And so if we see the US dollar falling, which is quite possible, then you can see gold rising from there. So there's reasons to have it within a portfolio, I think, at this point. And largely the reasons I've got it is either because the inflation story does get far more believed than what I think, or in case I'm wrong on this, and it is, inflation does shoot off. So I think there's a position for it in your portfolio at the moment. But it's not a set and forget and hold it there forever. I think there'll be a point at which the inflation stats will all start rolling over, and that won't be until late this year, early next year, and that'll be there'll be time to revisit that holding at that point.
And I'll just make the point that both silver and gold are effectively trading in manipulated markets, right? We know that there's a lot of derivatives, there are a lot of cross positions, and in fact, if you look at the underlying and then all the contracts, there's a multiplier effect, which is pretty massive. And so there are people basically controlling the price quite firmly. We saw that the other day with silver, right, where there was a bit of a run up and then it sort of came back a bit and ran up a bit. So these are not simple, straightforward, clean markets. I know people keep claiming that gold and silver is not contaminated the same way as the stock markets are. I would argue that it's precisely the same.
Well, and the big issue with the gold and silver, well, silver less so, gold certainly. If I look at, let's say, the iron ore or the copper market, very little of that is owned where people buy it and then store it and then try and sell it back to the market. Like it's owned because there's a genuine need to build something with it. If you look at gold, the gold market, by far the biggest influence on the price is what investors are doing and what central banks are doing. So if central banks are buying or selling gold, that's the way it's going. If investors are out there buying or selling gold, that's what it's doing. So it's very much a second guessing, what other investors are doing. And so, there's, I think we spoke last time about whether, the story of Bitcoin, has Bitcoin the story, as a story overtaken. So Bitcoin's the new gold for the youth of today who want an asset that's not going to go down in the case of inflation. And so maybe there is an effect on gold from that, because it is very much a what they call a greater full investment. I'm buying this thing because I think somebody will be prepared to pay more for it later.
Yeah, and the point is, and it's interesting that Master Single has come up with it. Sadly, nothing is not rigged in some ways. That's the point. The point I keep coming back to. Wherever you look across markets, right, there are cross currents that people perhaps don't understand to be there. And markets are not logical and straightforward. There are players with big resources and big technology kits running around all over the place trying to get a turn and get a deal. So I'm unfortunate. And it's not all about market efficiency.
No,
it's way too complicated.
I guess what I'd say though is the gold market at least is big enough that it's very hard for single players to do much good.
Exactly.
It needs to be concerted effort.
Yeah. Now we should come back to this question of the virus. You had one last chart which you haven't shown, but we should probably go with that now. Yeah.
So this is this thought around, and I'm interested in, I'm sure there's. When it comes to the virus, everyone's got a view, and it's of interest in the comments that from your listeners, and watchers. This is my rough thought around the vaccine: is that the problem with the coronavirus is not that we need to completely eradicate it before we can go back to living society as it is. The problem was always in my mind that if we let this thing get out of control, then it overruns our hospitals. And once our hospitals are overrun, then people start dying from, people turn up from a car crash and they can't get in because the hospital's full of people from coronavirus. And so we need to put these lockdowns on so that the hospitals don't get overrun. Now, as long as if you're on the same path with me there's other people who might disagree and say, no, we need to make sure this whole thing is completely eradicated before we can possibly open up again. But I think Australia's probably, because we've done such a great job keeping it out, there might be that view way more than what you'll see elsewhere. And so if you're following me though, that the hospitals are most important, that's 75% of hospitalizations are for people 55% or over. So you don't need to vaccinate your entire population to really put a massive dent in your hospitalizations. And that's the area that all these countries are already targeting. They're targeting people who are below 55 who have pre-existing conditions that would see them in hospital, and if they got coronavirus, and they're targeting older people who are much more likely to end up in hospital if they get the coronavirus. And so if you can target enough of those people, and it doesn't need to be all of them, or it doesn't even need to be, it actually might only need to be 60-70% of those older people. You've actually put enough of a dent in it that your hospital system now can handle outbreaks. And if you've got all your frontline workers are all vaccinated, that's your other problem, is that, in these, when your doctors and your nurses and everyone starts going down with coronavirus as well, then all of a sudden your hospital system stops. But if we've sort of ruled that out, and so we're back to saying our hospital system now can handle enough people, and especially in countries where people have at least been offered, they've been given the opportunity to get a vaccine, and if they've chosen not to, and then they end up in hospital, it's like, well, that's back on you. I could see that you could very easily see that places will start opening up sooner rather than later. That they will get through those. They're targeting that. They're exactly the groups that are being targeted, and so you can see that sort of getting into the somewhere between sort of July, August, September, that sort of quarter. I can see that there's countries that will start to look at, do we start opening up and just going back to normal now, because we've inoculated all the older people, we've got our frontline workers done, and the people who haven't, everyone's been offered the chance, and then of the younger people, they're much less likely to go to hospital, and they've got the chance to get the vaccines as well. So that's I guess where I'm thinking. I'd be interested to throw it back to see your views, Martin.
Well,
and also see what
you've got a few comments, so yeah.
Let's go for it. What are the
Okay, so you want to put the screen back to yourself, and I'll put this up. So this was from Otto, which the stats are only true for the original virus. The B.1.1.7 variant affects children as much as adults, and it's becoming the dominant strain. Certainly, the issue of the evolution of the virus is something which is hard to track and to factor in, I guess.
And look, that is a major risk of all this. Is if you want to have this vaccine's got one of the biggest. It's got such a wide variety of millions and millions of people with it. It's got the chances to mutate, absolutely. And so, you could definitely see mutations that could cause problems. But on the flip side is, we've seen now 600,000 people from Israel, going through the case, and 94% reduction in hospitalizations. And so, yes, people will still get it, but at that stage, I think, I've been very much on that case. This is not just the flu, but I think if you're at the stage where 94% of people don't get hospitalized if they get it, well, you're pretty close to this is just the flu then, if you've got a vaccine for it.
Yes, yeah, and it's interesting. I've just put Donald's comment up there because there are people with particular medical conditions where it makes probably more sense. My own wife is going to have to get the vaccine and as early as possible because she's highly exposed. And if she got it, she would be in really, really serious issues. There are other people who are, a little bit more cautious about the vaccine, I guess. But to me, the real issue is we've got to try and look at this on a global rather than just a national basis, right? Because the borders won't be fully open unless we can be confident that we're not going to import it like we've been importing it on and off over the last few months.
Yeah.
Look at Victoria now.
And that's what I was saying. It's very different for Australia. If you're sitting in the US now or the UK where it's already running rampant through your society, and then you're saying, okay, we've solved the problem with hospitalizations now. It's already running rampant. We know we can't control it. Well, we may as well throw the borders open now. And as long as everyone's had a chance to get this vaccine, then, and especially anyone who's at risk, then you're back to normal. And that would be very interesting for Australia then if the rest of the world's all, US, Europe, UK is all traveling back and being normal. There'll be a lot of pressure on Australia to do the same.
Absolutely. And the second point I was going to make was, of course, that the virus, the more it's out there, the more it changes, right? So effectively trying to stop the transmission and trying to stop the very significant infection rates in the UK and in the US are critical to stop more mutations coming through, right?
Yes.
And it's quite interesting because I was talking to a couple of experts the other day who said, look, there's two ways to play this. It may be that the virus is sort of coming to the end of its natural sort of evolution cycle and we won't see many more variants. But one of the other experts said, no, you've got to understand, this virus is really able to evolve multiple ways. It's just pure evolution, right? And if there's an alternative that is stronger and more able to propagate, it will become dominant. And therefore, you've got to take this seriously and you've got to actually understand that this is not over. Even when you do the vaccination programs, this is just the start of the control process. This will take a number of years. And I think sometimes we do get a bit over-optimistic, saying, well, it's all going to be fine tomorrow afternoon, right? It'll be better. It'll be a lot better. But there is a long way to go, unfortunately.
Yeah, absolutely. And that's a very good point, is I'm not trying to say we're back to normal. I'm just saying from a economically speaking and from a travel and tourism and all that, I think you're right. This is something we're going to live with now for, potentially forever. This is just a new, there's just a new variant of the flu. And you do need to be vaccinated regularly for it and the next strains. But,
And swinging that back to the markets basically are banking on, a quick exit, I think. And it may well be that one of the things that wobbles later in the year will be the fact that maybe this is less conquered than we thought it was going to be in that time horizon. So,
I think if you're looking at stocks and thinking, yes, I'll buy this stock because because coronavirus will be done and we'll never hear about it ever again, then I think that is a mistake. But I also, and this reporting season very much showed it to be the case in my view, is that there was a lot of companies that were running businesses with a fair bit of fat in them, and they just, people that they'd hired people that and built up their middle management and didn't particularly need them, but didn't want to go to the hassle and the, let's face it, the stress of having to fire people. Coronavirus hit, and they went through and wiped out as many costs as they possibly could. And now they're sitting looking at their accounts and saying, wow, we're actually, our revenues have fallen 5%, but we're actually just as profitable or more profitable than what we used to be because we cut out so many costs.
Yeah.
And there's all this extra government stimulus coming, and that's sort of, ending up with companies as well. I think there's a patch where companies, the earnings are going to do a lot better than what people are expecting.
Absolutely. Well, believe it or not, we've come to the end of our time once again. I haven't got through all the questions, but we've got through quite a few of them. Any last thoughts before I close the show?
Given you've got I should have brought up the YouTube myself here. But are the thoughts on the virus that I'm crazy, or are the thoughts on the virus that what's the rest of the rough agreement?
Well, it's actually quite a range. So that there are a number of people basically saying, they'll probably not get the vaccine immediately. There are others saying it'll be forced on us, etc., etc. Some saying, well, if I get vaccinated, I'll put this one up from Vanessa. If I get vaccinated, I'm buying more Cambridge masks just in case, right? So, I think if people are beginning to realise that maybe there's more to it than just getting the vaccine and hoping that everything is going to be free. And Smooth Opera said just that Flemish would never get a vaccine for it so be careful, right? So I think there's a little bit of issues there, right?
Yeah.
Now,
but I think the big economic issue for me is, when do you open up for tourism and normal? There's something out there that is causing more people in hospital and more people dying than usual.
Yep.
But it's not so bad that it's overwhelming hospitals. I think people learn to live with it. As sad as it is, people learn to live with that. There's lots of diseases we've learned to live with, and this will just be one more of them once you got it to an acceptable level.
No, I just must put this one up. Dylan, thank you very much for the super chat. What are Damien's thoughts on pulling out of your crypto and investing in physical chickens?
I think that's, well, I think if you like eggs, as long as you like eggs, I think there's or I suppose taste of chicken as well. I think that sounds like a very good trade there, Dylan.
Is that all your eggs in one basket? I don't know. Maybe it's not. Thank you, Dylan, for that. Okay, well, Damien, once again, I've really enjoyed having you on. Thank you very much for your conversation. Thanks to Jason for that contribution too. Really appreciate it. It's been a really fascinating walk through. I think a level of uncertainty is what I'm taking out of this, right? There are some interesting signs, but there are also some contradictory signs as well. And the truth is,
everywhere.
Yeah, and I think that's what I need, as I try to sort of paint my picture of what's going on, that effectively, the simplistic, frankly, mainstream story that suddenly magically everything's going to pop right and suddenly everything is going to be back to normal is probably a little bit too simplistic for what's really going on. The same it's true with the markets, may go up, may go down, may go sideways. So a degree of caution is probably what we're saying, but also very important to keep watching for the signs, because as things change, there will be some indicators of changes in trajectory. And I guess what we'll try and do on the channel here is to bring some of those to people as soon as we can. Yeah, absolutely. Sounds good. Great. Well, and just to say, as I do, is that Damien runs the Walk the World Super and Walk the World Fund. If you do have interest in market-related investments, they are very good at what they do. There's a very simple process to get access, and no hard sell. But there's a lot of information at walktheworld.com.au if you want more information. Damien, thank you for your time today. Really appreciate it. And we'll do the same next month, by which I guess we'll know more. But how much more? Who knows? Yes, that's right. We'll have a bunch more contradictory signals, I'm sure. Right. Well, thank you very much. I'm now going to tidy up the rest of the show. So I'm just going to say, Damien, thanks very much. We'll catch up with you again soon. And in terms of just closing out the show, next week, just to let you know that There will be another live show. I'm bringing Adam Stokes on. I don't know whether you've come across Adam, but Adam runs his own YouTube channel and covers digital, Bitcoin, those sorts of things. So we're going to have a deep and dirty conversation about Bitcoin, the digital revolution, and even things like decentralized finance and a few other things. So that will be next week. I think that'll be worth watching. And so come along next week for a digital extravaganza. Meantime, if you've not seen it already, I posted a show today with George Gammon on the Great Reset. I'm doing a series on the Great Reset because I think it's probably one of the most critical conversations that we need to have at the moment. So there'll be more on that over the next little while. And other than that, I just want to say thank you all very much for spending some time with me. It's been a good show tonight, good conversations. Thank you very much for your engagement and for your questions, and also all the cross-commentary as well. I've been following some of that, if not all of it. We'll see you next time, and have a good evening. Keep safe. Martin North from Digital Finance Analytics, signing off. We'll see you next time.